So high yield stocks have been on a pretty good run here since really the middle of the year, since the beginning of July. And a lot of that's been fueled by Federal Reserve rate cuts and expectations for more rate cuts, expectations that inflation is going to come down. But there's still some really compelling opportunities out there. And in today's video, I'm going to discuss two 8% yielding dividend stocks that have not really participated in the recent high yield sector rally, and as a result remain very compelling in terms of their valuations, their yields, and frankly, they're pretty quality underlying businesses as well, presenting investors with a really golden opportunity. Before I get into the video though, if you could please give it a like, greatly help in its distribution, help me grow my channel, my audience. Thank you very much. Okay, so the first 8% yielder I'm going to talk about today is Energy Transfer. Now, it does issue a K1 tax form, so for those of you who don't like to deal with those, I'm sorry, you're either going to have to skip it or maybe invest in an ETF like the Global X MLP ETF. MLPA is the ticker symbol. It only has a 0.45% expense ratio, has a large position Energy Transfer, so you can still get that exposure to that. And other high quality K1 issuing MLPs will not having to deal with the K1, and the fee is fairly reasonable. So that's an option that you can consider as well. But without further ado, let's dig into Energy Transfer. So again, it's got that 8% forward distribution yield. That's quite attractive. It's covered 2 times approximately by distributable cash flow, making it a very, very well covered, arguably the best covered 8% yield from any equity out there in the market today that I know of anyway. It has a BBB credit rating from S&P, so it has a solid credit rating, has a strong balance sheet. It's got its leverage ratio well within its target ratio. In fact, it's expected to be in the lower end moving forward. So it has that flexibility you can use to return incremental capital to unit holders or to invest it in attractive growth opportunities. It recently redeemed almost all of its preferred equity, which again, at high yields, so helping to reduce its cost of capital, further increasing the safety of its distribution because those preferred distributions had priority over the common distribution. And so that's removing one high cost of fixed obligations on its balance sheet, much higher cost than its debt. So that's a good move there. And they're going to continue to opportunistically reduce leverage and pay down debt as well. They have well staggered debt maturity. So again, no pressures there on the balance sheet side. On the business side, they have very stable cash flows. Only about 10% of their EBITDA is expected to come from sources that are sensitive to commodity price swings. So again, 90% is pretty much all contracted assets. Very broad diversification across different sectors within midstream as well. They have one of the largest portfolios. They've done a lot of accretive acquisitions over the years to really diversify the portfolio, strengthen the moat, so to speak, around the business. And so they have a lot going for them there. They also, they're retaining a ton of cash flow. And so they're using a lot of that to invest in a growth pipeline to further strengthen the business, to further diversify, to further grow the cash flows per unit, to reduce leverage as those projects come online. So they got that going for them. They've not begun to repurchase units yet, but management has said that's certainly an option for them. They're expecting to grow the distribution at about a 3 to 5% CAGR moving forward. So not only are you getting that 8% current yield, but it's supposed to, its purchasing power is expected to keep up or even exceed the pace of inflation over time. So you've got a lot going for you here with Energy Transfer. Its valuation is quite low too. Its EV or enterprise value to EBITDA is just a little bit over 8 times, which is a full turn below many of its peers like MPLX, Enterprise Products Partners, and others. And so again, it's quite cheap relative to a lot of its peers, especially for what you get. And so I think ET is definitely worth considering right now. Okay, you'll be happy to hear that the next 8% one that dividend yielder I'm going to talk about does not issue a K1, and so it's going to be more available to many of you. Before I get into it, if you could please subscribe to this channel so you don't miss any more of my future content, I'd greatly appreciate it. Help me grow my audience. Thank you so much. Okay, this next 8% dividend yielder is Armada Hoffler Properties. It's ticker symbol AAH. And it is a real estate investment trust. And so it holds a portfolio of diversified real estate assets. It actually is increasingly being identified as a mixed-use REIT, which is a new type of REIT. It's one that there really aren't out there. Traditionally, it's been what you consider a diversified REIT. It's held a mixture of retail, multifamily, and office properties. But as you well know, office and retail both have been out of favor, and really multifamily even has been some now recently. And so, it trades at a 20% discount to its net asset value, and, not without reason. Again, office has struggled. Retail went through a period of being hit hard before and during the COVID lockdowns. And, again, multifamily has been overbuilt in some markets. And so it's very understandable why the market may not like this one. And on top of that, AAH, they have high leverage. As of the last quarter, they had like 7.5 times net debt to EBITDA. So again, a pretty elevated leverage ratio, and management just issued a bunch of shares, which obviously the market didn't like either. But if you think about it from the current moment moving forward, first of all, they've been growing the dividend pretty nicely in recent years. So it's a nice dividend growth stock. It's well covered by adjusted funds from operations. So again, it's an 8% yield that's fairly well covered. So that's attractive. But also that equity at issue, it used it to pay down a lot of expensive debt and de-risk the balance sheet, increase balance sheet flexibility, and they're funding developments with it. And so once those developments come online and become fully stabilized, that's going to dramatically reduce the leverage even further on top of what they just did with this equity issuance. Their leverage ratio today is lower meaningfully than it was at the end of last quarter, and as these developments come online, it's going to fall even further. So they really took a huge step forward in strengthening their balance sheet and addressing that concern with this equity issuance. So again, maybe it wasn't the best use of capital. Maybe they could have raised equity capital through a different means. But at the end of the day, it helps solve one of their problems. So if you're just buying today, you're going to get in a lower stock price than you would have if you'd bought before that equity issuance, and the balance sheet's a lot stronger. And so I think for us today, looking forward, that's a big win for the thesis. Another thing to consider is that the office assets, yes, that sounds bad, but it's Class A office, has a 95% occupancy ratio, and it's declining as a percentage of their overall rental income because they are diversifying again through developments into these mixed-use communities. And again, also a lot of their office assets, in fact, the vast majority of them, are part of mixed-use properties, Class A mixed-use properties. So you got Class A retail, it's high-quality retail, that's very resistant to Amazon. It's stuck around. Again, if retail's still around, it's doing well, it's probably a pretty decent asset. So it's retail's doing well. It has attractive multifamily properties that are included in these assets in good markets. And then again, these offices, Class A office, and it's in a mixed use place. It's a live, you live in the multifamily apartments, you work at the office, and you play at the retail with entertainment, and you can shop, etc. So it's live, work, play areas, live, work, play, shop. Even you could add it further, are these communities. And so they're very attractive. You don't need a car, or at least you don't need to use it much if you live in one of these places because everything's such close proximity. It adds a lot of value. It builds a moat of sorts, a competitive advantage for each of these types of assets because they synergize really nicely together. And that's what AHH is focused on. Again, in strong markets. And they've got a pretty good track record. Actually, they did very well before the COVID crash. And since then, they've done a good job of rebuilding as well. Of course, they got whacked during COVID because of the lockdowns, which hurt the office and hurt the retail. But they've recovered nicely. And again, their balance sheet is now going to be on much stronger footing. Once these assets come online, their leverage ratio is going to be even lower. And so again, you can buy in at 8% dividend yield, 20% discount to net asset value, high quality real estate. What's not to like, quite frankly, especially as part of a broadly diversified portfolio of dividend stocks. So there you have it, 2 8% yielders, Energy Transfer, Armada Hoffler Properties. Let me know in the comments below what you think of these opportunities and if there are any other 8%ers out there that you like more. Again, if you like this video, please give it a like, subscribe to my channel. Let me know in the comments below. Thank you so much. See you next time.